You own property, you might be sitting on tens or even hundreds of thousands of dollars that you could potentially be using to go and purchase more properties. Today, I'm going to break down very simply what equity is, how to use it, and some things to avoid. So the next question would be is how do we access this equity and what is the process to do so? And then we rinse and repeat exactly those steps over and over again until we get to the desired position that we want to be in. And the banks can actually take both properties from you. It's really only valuable if you know how to use it and you know how to use it properly. You own property, you might be sitting on tens or even hundreds of thousands of dollars that you could potentially be using to go and purchase more properties with and continue building your wealth. Today, I'm going to break down very simply what equity is, how to use it, and some things to avoid. Very simply, we're going to break some things down and explain how you can use this to your advantage. Welcome back to the Smash Property Podcast. I'm Nick V, director of the Smash Property Buyers Agency. And this one is going to be back to basics explainer about equity, how to use it, and use it to your advantage. Now, I have obviously done this myself, so all the stuff we're going to go through is pretty much all the things that I've sort of seen, learnt, and done over the years. We obviously also help clients, purchase properties using equity and all those sorts of things over the years. Before I get into it though, none of this is financial advice. I'm not a broker or anything like that. I'm just sharing this for sort of educational purposes. But let's sort of dive straight into it and just explain what equity actually is. So let me just explain. I'm going to draw here on the iPad. So let's say we've got our house very nicely. Now the house is obviously going to be worth something, right? So the current value of the house, if we can put it here, let's say hypothetically, the current value of the house is $800,000. Okay. Now, for the most part, most people are going to have a debt on their properties. Now, again, hypothetically, let's just say that the debt on this particular property is $500,000. All right. We've bought this property some time ago. We put down initially a 20% deposit and we've steadily paid down some debt over time. What that means is the equity of this property will be the difference between what it's currently worth and what the debt on the property actually is. So in this example here, we have equity of $300,000. Okay. Now you might hear us refer to or frequently talk about usable equity. Now, when we talk about usable equity, for the most part, usable equity generally refers to that most banks will lend up to LVR. So 80% loan to value ratio of the particular property that we have. So what that means is banks will lend up to 80% of the 800,000. In this case, the bank will be willing to lend us, subject to us being able to service the debt, which is another topic, but we're happy to lend you up to $640,000 based on the current value of this property. But we've obviously got the debt of $500,000 there, right? So our usable equity is the difference between what the bank is willing to lend at an 80% LVR and the current debt. In this case, we've got $140,000 sitting there that we can potentially do something with. So the next question would be is how do we access this equity and what is the process to do so? Now, there are really two main methods to access the equity that we have here. Now, the first and most common and my preferred method is essentially a loan top-up or an equity release. What that will actually mean is you will go to your bank or your broker and you'd say, hey, I think I've got some equity in my property. I'd love to refinance and pull that equity out of the property. Now, a bank is generally going to do an assessment of your borrowing situation. They'll work out, can you afford to actually manage that debt and take that extra debt on? In a scenario where you are able to, you've got the serviceability, a lot of banks will, after the assessment is completed, they will do a loan top-up or an equity release. And what will happen in this scenario here is, remember, we had original debt of $500,000 against the house. What would happen after the equity release is the debt on this property would now equal $640,000, right? So you would have repayments increase to repay the debt of $640,000, but in a separate bank account, generally, I would always get the equity cash released and put into an offset account, which is tied to the debt of the property that we have released it from. The reason I park it in an offset account is because until I'm using it, I'm offsetting $140,000 of interest against this particular property. So technically, until I use this $140K, I'm still only paying interest on the $500,000 that is sitting there. So that is essentially your debt has now increased to $640. You have $140,000 sitting in an offset account as cash ready for you to use as a deposit to go and buy another property. That's most common method there. What a lot of banks tend to want to do, and what I fell into the trap of, is some banks will want you to do what is called cross-collateralization. Now, briefly, cross-collateralization means that you have your main property that you originally owned. You go and they will allow you to go and buy another property. They'll basically give you pre-approval to go and buy another property, but the cash is not sitting in your account or anything. But essentially, they will then tie these two properties together. So every time you need to potentially get a valuation done, every time you want to refinance, these two properties are connected together. The reason why this is a bad thing is if anything happens to your ability to pay back the debt on one of these properties, both of them are actually then going to be impacted, and the banks can actually take both properties from you. Whereas if you are not cross-collateralized, you don't have that particular issue because these two properties are separate. That is why I don't recommend cross-collateralization. It can be beneficial in some very unique circumstances. Some banks will offer you better rates to do this. Some banks will give you better incentives to do this because it is more favorable for the bank to have this sort of loan set up. But as an investor that wants to use equity and repeat this process over and over again, this is not a great outcome. So avoid it if you can. You have to do it. If it means you're going to get another property and it's the only way to do it, then maybe do that. But definitely speak with your broker before you sort of make a decision on whether you cross-collateralize or not. So now we've released our equity. We've got the equity sitting in our account. We had $140,000 in usable equity that's now just sitting in an account. And this is where you've got to be very selective and careful about how you use this money. This is not just yours to go and, buy a jet ski with it or go and buy another car or, go on a holiday with. I mean, you technically can, but then you lose your ability to claim any interest deductions on this money that's sitting here. So it's very critical from a tax perspective that you don't touch this and mix it with anything else. You should just be strictly used as the deposit to go and fund the next purchase, which is exactly how we go and use this equity. Remember, it's just cash sitting there. So what will happen then is we can go back to our broker. Likely your broker's already going to know that you want to do this. And we say, hey, now we've got the equity release. Let's go and do a fresh loan application at another bank so that we can get our borrowing assessed to see whether or not we can actually go and purchase another property using this equity we have here as the deposit to go and fund the purchase of the next property. That's how you would want to use the equity to fund the purchase of a next property. All it is essentially you've increased the debt on the first property, right? You've taken the cash out of that property. It's sitting in your account. You use that cash. You go back to the same or another bank. Say, hey, I've got this cash sitting here. Can I use it to go and fund the purchase of the next property? It is really that simple. Now, there's a couple of things that you'd want to consider before, go down this particular path. Now, the reason why you might want to do this is because properties tend to grow in value quicker than we can actually save. So if you've bought a property, if you've already got one, chances are it's likely grown in value. The longer you've held it, the more equity you've potentially got sitting there. And the reason why this is good is we can then use that to fund purchases a lot quicker than we're able to save, right? Because if I was to buy my first property now and I buy my first property cash, the chances are for me to save another 100 grand or more as a deposit to go and buy another property with, it's going to take me years to be able to do that. So this really fast tracks your journey as an investor. And this is why you see a lot of investors, they can really buy multiple properties quite quickly. We work with investors that buy multiple properties within 1 year. Every 3 to 6 months, they're buying multiple properties. And this is the method that they use to do that. So some common mistakes to avoid when you are using equity to go and fund the purchase of your next property. Now, there's a lot to consider. Now, the first one I'm going to say is over leveraging. Now, the reason why this is an important one I want to talk about, over leveraging is using equity is just another way of saying using debt to go and buy more properties with. And when you use debt, your debt position increases, your need or your loan repayments increase with it, and therefore that eats into your cash flow that you need to go and fund the debt that you have. So it's very easy if you don't know what you're doing to get in a position where you're over leveraged. This is why planning the cash flow out when you go down this path is so important. Before you even do any loan application, run the numbers, punch it into an Excel, work out what the current property you own, what the debt repayments on that currently, what is the interest rate you're paying. If you were to increase the debt on that first property, because that's what you would be doing, what is the repayment then going to look like once you have that, right? It's likely going to be a lot higher than what you're currently paying. The second step would be on the second property that you're going to fund a purchase. What does the cash flow position look like on that property? Because when you combine the two together, your debt position is going to be much higher and your loan repayments collectively are going to be a lot higher as well. So planning out cash flow is very, very important in managing your lifestyle when it comes to building your property portfolio. And this is where I often say, a lot of investors often ask me is, how do you build a portfolio quite quickly? There's a couple of things need to happen. You either need to be increasing your income whilst you're doing this, which is what happened in my case while I was working at the bank. That is really the number one way in which a lot of investors are able to buy a lot of properties in a short period of time. You need income to service the debt. You can get a little cute with it if you're using trusts and properties that completely taken care of themselves inside of a trust. That is probably for more advanced investors, but if it's your first couple of properties, it's likely going to be in your personal name, and that means you need to be able to show the bank that you can pay back the debt. So be careful with over leveraging. Make sure that you plan for the cash flow for everything, for all the properties, and do it before you do any applications, because you don't want to get locked into something and then you're like, shit, this is not going to work out for me. And I would be, again, very cautious about cross-collateralizing everything. Like I said, if cross-collateralizing means you can get your next property and it's the only way, look at it, understand and ask the broker the risks, or the pros and cons of cross-collateralizing. Do a bit of research yourself. Google, ChatGPT can really explain quite quickly what cross-collateralizing is and what to look out for. And so those are some of the common mistakes to avoid. The biggest thing is just don't over leverage or be very cautious about it, and make sure you run your numbers before you get locked into any particular deals. So let me talk about how to build and plan a property portfolio, how to grow a property portfolio over time using equity. Now, the number one thing is we need to buy well. And so what do I mean by buying well? This is where you might commonly hear property people say buying below market value. The reason why this is so important, particularly if you want to grow a property portfolio quite quickly and you want to buy it below market value, this is because the lower purchase price you buy, the more equity you are going to have. Now, the better you're able to do this, the better that you're able to buy below market value means the better and faster you're going to have equity. So as an example, what we tend to do is we go and buy a property. I love to do this. So say the property is actually worth $500,000, but we, based on negotiation connections, we're able to pick it up for $480,000. Now you might be saying, who in their right mind is going to want to sell a property for $480,000 when it's worth $500,000? Believe me, there are tons of different reasons as to why this is the case. Sometimes agents don't even know what it's worth. Sometimes the deal, person needs to get out of the deal really quickly. There are 1,000,001 reasons why, but as a buyer's agent, we are doing this every single week without fail. So this is why, for example, we buy it for $480, it's worth $500. So immediately this investor has $20,000 in equity sitting there. Now, that's not $20,000 of usable equity. Remember, we can only do up to 80% of the value of the property, but our starting position for the property to grow over time is giving it the best chance possible. So we're not waiting on the market to grow in value by 20K. We've already got that sitting there. Whatever the market does after that point is then going to just supercharge this 20K into 30, 40, 50K. This is how, and you might have heard us if you follow some of our content, a lot of investors that we work with have $50,000, $100,000 in equity within 6 to 12 months of purchasing, is because we buy well. So the number one thing when you're buying property is to make sure that you buy well. And you might hear people talk about you make your money in property when you buy. That is the reason why. Now, number two is we've got to let time do its thing. So we've bought the property well. We've bought it below market value as much as we possibly can. Now, time is our friend here. The longer we hold the property, the more equity that we are going to grow and get over time. Now, this is where, depending on the market that you buy, right, depending on where you've bought and what the annual growth percentage actually looks like, this is going to then dictate how quickly the equity is going to rise. Now, this is where knowing the right market to buy in, the market cycle timing, because every market is moving in a different state, different nature. So having a good understanding of the market here is really important, so that we buy really well, we buy it at the right time in the right market, so then the market moves and it grows as we buy. Right? So timing the market and then time in the market is both a critical component of allowing your property portfolio to grow over time. So then we get to step 3, and then we revalue, we reassess, we release the equity that we have in the property. Now, the timeline for you to be able to do that is, obviously you want to do this as quickly as possible, because the more properties that you have in your control in as quick a time span as you can do it, is the quicker that your net worth and your net position is going to grow over time. And I guess a critical component of being a property investor is the quicker you buy, the faster you buy, the longer the compounding effect actually is. So we revalue the property situation that we've got, and then we rinse and repeat exactly those steps over and over again until we get to the desired position that we want to be in. For some people, that's generally no more than 4 to 6 properties max to really get set up for retirement, to really get set up so they can leave their job. You don't need to have tens and dozens of properties to be able to do this. Some investors get to a certain point where they thought they wanted to be, and then they get there and like, oh, well, this is cool. Let me keep growing from here, right? So the options do become pretty much endless once you get to this position where you have multiple properties. They're all growing in value. Cash flow position's quite good. It's not impacting your lifestyle too much. And that just comes with time. You hold through a market cycle like many people talk about, and you get into a position where the debt over time becomes irrelevant, right? And I've said it many times on other podcasts, is you pay today's debt with tomorrow's inflated dollar, right? So over time, inflation actually erodes the value of debt. This is why so many investors that bought properties, say 10, 15, 20 years ago, they would be laughing now because the price point they would have bought 10, 15, 20 years ago would have been less than half of what they would have paid today. Their debts would be irrelevant from, say you bought in Sydney, 15, 20 years ago, you would have been paying, $600,000, $700,000, $800,000 for a house, maybe, right? The debt on that might have been, $550,000, $600,000, whatever it might have been at the time. Those properties are now double, tripled in value, but let's say they didn't pay down a cent of debt, right? They got $500,000-$600,000 worth of debt on a $2 million property. It's insane, right? This is why I say there'd be so many people out there sitting on tons of equity that's usable that they can go out and continue building their wealth with. So you rinse and repeat that, get to your desired position. Now, you've got to be careful about having cash buffers in there for unexpected interest rate rises, or maybe things in your life particularly change. You've got to understand the yield and the cash flow positions of the property so that you can actually manage it and it doesn't into your lifestyle too much, depending on how aggressive that you want to be. So this is what I just showed you was, I guess, the framework and the plan. You've then got to ask yourself multiple questions about how you want to execute on that plan, which is really, really important. So that's the secret weapon, I guess, to many property investors' arsenal, is using equity and using that to go and fund and pivot into different deals, more properties, growing their wealth, growing their portfolio. But it is really only valuable if you know how to use it and you know how to use it properly. So if you're sitting on the fence, or you might be sitting on some equity, you might not even know it, and you want to find out how you can work it for your specific circumstance, our details are in the description below. We do have a team of brokers that can help depending on your situation and circumstance. So if you want to book a call, book a time to have a chat, doesn't cost you a cent. The details are in the description below. If you got some value out of the podcast, appreciate it if you could like the video, maybe share it with a friend that might find it useful, and consider subscribing for property content we deliver every single week. But until next time, thank you so much for watching. I'm Nick V, Director of the Smash Property Buyers Agency, and I'll catch you soon.